Coming up on market shares, two of the three largest bank collapses in American history happened the past 2 weeks. We'll have a full rundown from all angles on the potential crisis.
Plus, Fed rate hikes are on the horizon again. See the market's reaction to the effort to combat inflation.
And Fox Corporation's in hot water with a defamation lawsuit from Dominion. We'll take a look at the implications. Hold on to your wallets because market shares starts right now.
Good morning and welcome into Market Shares. I'm Peter Elliott.
And I'm Bradley Hoppenstein. We begin today, as always, with our market update. You know, it's funny, Peter, we only missed 1 week and we missed the second largest bank collapse in U.S. history.
1 week to be off. I mean, like one of the biggest weeks since 2008, really. An unbelievable week for the markets.
But that gives us a lot to talk about today. Let's start with the Dow, another volatile week. But let's take a look at the Dow. The Dow ending the week near 32,238. Its weekly gain about 1.2%, but this week, the big news this week is we have the Fed raising interest rates another 25 basis points. But all three major indexes still squeezing out a winning week, but there's a lot of uncertainty in the banking sector, not just the U.S. banking sector, but the European banking sector as well. Treasury Secretary Janet Yellen saying this week, on the same day the Fed raised interest rates, she said she's not considering any kind of blanket insurance for banking deposits, and that's really important moving forward for the banking sector and the markets, Peter. Let's take a look at the NASDAQ.
Yeah, Bradley, there are tremors all over the global economy. People are really worried about a potential collapse of the banking system, and so all eyes are on trying to assuage the consumers and the banking industry. The NASDAQ also up on the week. There were concerns on Friday about the health of Deutsche Bank, but still we're seeing positive movement in all of the major indexes. The NASDAQ, obviously a tech-heavy index, but we saw that industry can be impacted by some turmoil in the banking industry, especially with Silicon Valley Bank, but still the NASDAQ up on the week.
Yeah, not too bad. All three indexes up on the week, especially with all of the uncertainty across the markets. And one more, let's take a look at the S&P to round us out here. Up about 52 points on the week, close to 1.5%. The S&P, analysts are predicting big moves for the S&P, even with the uncertainty in the markets. And we could really attribute all three indexes being up this week to the Fed raising rates. We know there's a lot of uncertainty in the banking sector, but the Fed raising rates is going to be a key measure for inflation moving forward, Peter.
It sure will, and it seems like the Fed will continue to raise interest rates as they're still worried about combating inflation. So we're seeing a lot of turmoil. The Fed is kind of fighting a war on both fronts now, trying to fight inflation, which they've been doing since pretty much last year, and now trying to shore up the banking sector and make sure everyone is not concerned about further collapse in that sector.
Yeah, absolutely. And on that note, moving forward, let's take a look at our market movers for the week. We're going to start things off, Peter, with you. You have Activision in the news this week.
That's right. I enjoy playing Call of Duty occasionally, and that's what Activision is known for. But also, they're known for recently an acquisition by Microsoft, and the company's stock soared on Friday. That's because over in the United Kingdom, their Competition and Markets Authority, they dropped their concerns over the company's acquisition by the Seattle-based giant Microsoft. That's huge news for acquisition. The authority said they determined that acquisition would not significantly impact competition in the games industry. So that's good news for Blizzard.
That is good news for Blizzard. Let's take a look at a bit of a different stock. Let's go to the retail business. Let's talk Lululemon Athletica. They started the week around $2.95 a share, but ending close to $3.15. Now, here's the interesting thing. Their 52-week high is $4.10 a share, so many investors think Lululemon is starting a comeback. The stock's still down 3% on the year, but they're releasing their first quarter numbers on Tuesday. They're expected to beat expectations, and their annual profits over the last 5 years up almost 30% each year. They're expected to rise about 20% year over year the next 5 years, Peter.
Wow. Bradley, I think you might be single-handedly responsible for that stock's performance over the last...
I do own about half their inventory.
I was about to say, if they made a suit, I think you absolutely would wear that on air. My final stock of the week, it's actually down, is Microchip Technology Incorporated. Now, here in Central New York, we know a lot about the semiconductor industry. It's because Micron is trying to move into Syracuse, down over in Clay with their huge plant. But we're seeing some pulling back on the semiconductor industry because there's been so much investment in it recently. So there's less demand, and we saw in South Korea just last week more plans for additional factories. So there seems to be a cooling off in that sector. Now, that shouldn't have a major impact on what Micron is doing in Central New York. Actually, their stock is up this week. They had a strong week as they announced more plans in the future in their horizon for plants. But still, a lot of movement in the semiconductor industry.
Yeah, we'll definitely have to take a look on the local implications of that.
For sure. And amid all the turmoil in the banking sector, the Federal Reserve is expressing caution. The central bank hiking interest rates a 1/4 percentage point on Wednesday. It's the 9th consecutive hike since March of last year by the Fed, and the latest move in its ongoing effort to curb inflation. Fed officials are forecasting another rate increase later this year, but Fed Chair Jerome Powell says the additional hike is not certain. Powell also says that the Fed will be watching to see if recent bank failures will slow lending in the economy. The Fed just continuing to raise interest rates, Bradley, and we could see that a 10th time sometime later this year.
Yeah, you know, it looks like, or you'd like to say, things are going to start to slow down, but the Fed has they've had their foot on the gas, they're trying to fight inflation, and it seems like that's really their only measure to fight inflation is they just keep bumping rates.
Right.
Now, GameStop is still alive, shares surging after the struggling video game retailer posted its first profitable quarter in 2 years. GameStop stock soaring 46% with a net profit over $48 million as opposed to a loss of almost $150 million this time a year ago. The company has overhauled its strategy to stay alive. The first step, of course, cutting costs. GameStop has already cut its headcount with a series of layoffs and more are likely on the way. But with the video game market continuing to move digital, we were just talking about Activision earlier, it's unclear how long GameStop can stay alive. We'll keep you updated on its lifeline.
Yeah, and that's as we're seeing layoffs across the tech industry. Meanwhile, for TikTok, the clock could be ticking on TikTok's future in the United States. TikTok CEO Shou Chew facing questions from lawmakers on both sides of the aisle during a marathon 5-hour hearing Thursday in front of a House committee. Chew's appearance in Congress comes as Washington is looking to ban or force a sale of the wildly popular video sharing app over concerns that it may be a national security threat. The Beijing-based company ByteDance owns TikTok, and lawmakers are scrutinizing the nature of ByteDance's relationship with the Chinese government, saying that it could be sharing U.S. users' data with the government. Chew says that the app has 150 million users in the United States and over 1 billion around the globe.
Peter, the question we're all asking this week is, how could a bank so successful collapse so fast? Not only that, but could this spark a broader banking meltdown? Now, let's go back to the root of Silicon Valley Bank's demise, dumping billions into government bonds during the end of near zero interest rates. Now, back to those bonds in a moment, but as far back as 2015, regulators were growing concerned about the bank's rapid growth and reliance on the venture capital world. But SVB kept moving forward, benefiting like few others from growth in the tech industry through the pandemic. Fast forward to last year, when the Fed began raising interest rates at the fastest pace in decades and layoffs starting to take over the tech world. So with interest rates rising, bond prices fall, so the Fed's steep hike in interest rates killed the value of SVB's bond portfolio. Now, reports say the bank's portfolio average was in the range of 1.8% return, far below the 10-year Treasury yield of almost 4%. So customers yanking their deposits in a frantic 48 hours. Now, before Silicon Bank became the second largest bank failure in U.S. history on March 10th, there were a lot of pieces that maybe were a few signs leading into that. So let's go to the natural place to start here. Here's Fed Chair Jerome Powell on the oversight of SVB and the Fed's new investigation into the bank and its collapse.
So at a basic level, Silicon Valley Bank management failed badly. They grew the bank very quickly. They exposed the bank to significant liquidity risk and interest rate risk, didn't hedge that risk. SVB experienced an unprecedentedly rapid and massive bank run. So this is a very large group of connected depositors, concentrated group of connected depositors, and a very, very fast run, faster than the historical record would suggest. How did this happen is the question. What went wrong? It's clearly we do need to strengthen supervision and regulation.
So the Fed investigating what went wrong, but a few factors that analysts saw leading into it. But the broader concern, are there similar weaknesses in other banks that have possibly been overlooked? Well, Powell says the American public shouldn't lose any confidence in the system.
These are not weaknesses that are at all broadly through the banking system. This was a bank that was an outlier in terms of both its percentage of uninsured deposits and in terms of its holdings of duration risk.
So the tech sector as a whole already suffering from a year of layoffs and pressure from the Fed. Silicon Valley Bank having massive exposure to this one industry, but Treasury Secretary Janet Yellen says the two aren't necessarily connected.
Although the tech sector has been suffering from a downturn and has had some significant layoffs, the problems of the tech sector aren't at the heart of the problems of this bank.
Yellen also adding that the government will not be offering any kind of bailout for the bank, even with President Biden issuing some emergency funding to support the banking system in light of the collapse. Yellen says she's more concerned about depositors in the bank and trying to meet their needs. And yes, other banks were rattled by the news. We alluded to that earlier. First Republic coming close to a failure. That's just the most prominent of a handful. Other major banks pumping in $30 billion trying to save First Republic, but still not being enough. It's likely going to have to sell. But the real tell for the future of the system will be that Fed investigation into SVB and what comes out of it. Bailout, again, off the table, but a lot of room for new regulations or changes to existing ones. And when we come back, the political blame game around SVB, political analyst Luke Radel takes a look at how both sides reacted to the bank's collapse. Stick with us.
Jason, let's go see your room.
What do you think? We kept it a little spare, so you can decorate it how you like.
Dinner!
Go. Excellent. Yeah, I saw you guys out there. We're the family. Oh, I thought you were on my team.
Welcome back to Market Shares. The collapse of several banks this month is alarming investors and sparking significant debate in Washington over how to step in. We're joined now by Market Shares political analyst Luke Radel to discuss how both sides are reacting to this potential crisis. Luke, what is the president saying about this potential issue?
Peter and Bradley, President Biden is pushing for more regulation on mid-sized banks like SVB and Signature Bank in the aftermath of their collapses. And he has someone to blame for our current situation. Take a listen.
During the Obama-Biden administration, we put in place tough requirements on banks like Silicon Valley Bank and Signature Bank, including the Dodd-Frank law to make sure that the crisis we saw in 2008 would not happen again. Unfortunately, the last administration rolled back some of these requirements. I'm going to ask Congress and the banking regulators to strengthen the rules for banks to make it less likely this kind of bank failure would happen again.
Ah, yes, it's all the last guy's fault, says the new guy. But what is the president really talking about here? Biden is likely referring to Title IV of the Economic Growth, Regulatory Relief, and Consumer Protection Act. The title raised the threshold for what banks were subject to regulation from the Federal Reserve, including which banks underwent stress tests from the agency to ensure their investment strategies are sound. The threshold was raised during the Trump administration from $50 billion to $250 billion. And as you can see here, Silicon Valley Bank had around $209 billion in assets, meaning they would have been regulated before these rules changes in 2018. It's part of a law signed by President Donald Trump in that 2018 bill and supported by Republicans and some Democrats. The sponsor of the bill has pushed back on many of the statements made by the president and others, blaming his law for the bank collapse. Idaho Senator Mike Crapo said in reaction to Biden's comments, quote, "This is simply blame shifting by the president because he knows that it's his policies that caused this." So let's take a ride on Senator Crapo's train of logic here. Step one, Republicans argue that the historic government spending under President Biden to the tune of $3.37 trillion, which is nothing to sneeze at, is responsible for this latest inflation. Step two, that 40-year high inflation is responsible for the Federal Reserve's rate hikes. Step three, those Fed rate hikes are responsible for the SVB collapse, for reasons that Bradley explained earlier in the show. So therefore, President Biden has to be responsible for the SVB collapse, right? It's a pretty neat series of events that could very well be true, but also conveniently leaves out any responsibility for regulators in this case. It takes the blame away from Republicans and Democrats who supported the changes in 2018 to Dodd-Frank. Meanwhile, one of the Democrats who opposed those changes was Massachusetts Senator Elizabeth Warren. She explained on the Senate floor why she did that following the SVB collapse.
If Congress and the Federal Reserve had not rolled back key provisions of Dodd-Frank, these banks would have been subject to stronger liquidity and capital requirements to help withstand financial shocks. They would have been required to conduct regular stress tests to expose their vulnerabilities and shore up their businesses. They would have had more aggressive regulators standing at their shoulder, looking more closely at every part of the bank's business.
At this point, both parties seem to be arguing past each other. Democrats are pretty much always inclined to push for more regulation, while Republicans are pretty much always inclined to blame the government spending and the Biden administration policy. And each argument has its merits and flaws. But whether they can come together and agree on legislation to address this issue still remains to be seen. For now, there does seem to be bipartisan interest in preventing a full collapse of America's banking system, which is a start. Peter and Bradley, back to you guys.
It sure is a start. Luke, thanks so much. Amazon is shedding its workforce once again. The Seattle-based tech giant announcing plans to lay off 9,000 employees in the coming weeks. That's in addition to the more than 18,000 employees whose jobs Amazon cut between November and January. This round of layoffs will particularly impact its advertising sector, the live streaming service Twitch, and its wildly profitable web services division. The company's workforce surged during the pandemic, but it's now cutting back on its workforce as layoffs are sweeping the tech industry.
And if you're looking to get your COVID shot or booster, you better hurry before federal funding runs out. Moderna is facing backlash over its plans to bump its vaccine price to $130 a dose once the government stops buying the shots. The company says the move will be necessary to ensure everyone who wants the shot can get it. This move is in line with Pfizer, which announced in October that a single dose of its vaccine will cost between $110 and $130. The government is expected to run through its stockpile at some point this summer. Capitol Hill has been pressuring vaccine makers to keep their shots affordable once the Fed steps back.
And a mass media giant could be in major trouble. Fox News and its owner, Fox Corporation, are facing a number of potentially damaging legal challenges. A judge is set to issue a ruling in the nearly $2 billion defamation lawsuit brought by Dominion Voting Systems against Fox News. Meanwhile, the network has been hit with additional lawsuits in just the last week. Market shares analyst Gustavo Madero is here with us in studio. Gustavo, what kind of trouble is the Fox Corporation in?
Thank you, Peter. Well, Dominion Voting Systems brought the defamation lawsuit against Fox Corporation and its right-wing cable networks, Fox News and Fox Business, back in 2021, arguing that the network spread false claims that the voting company was involved in voter fraud during the 2020 presidential election. Dominion argues that Fox endorsed, repeated, and broadcasted a series of verifiable, false, yet devastating lies about Dominion, including claims that their software manipulated the results of the 2020 election. Dominion is seeking at least $1.6 billion in lost profits and enterprise value, plus more than $1 million in security expenses and expenses combating misinformation. Dominion's court's filing alleges that Fox recklessly disregarded the truth and that some of its viewers believed the channel's narrative with such fervor that they even took the fight to the United States Capitol, inciting violence and terror along the way. The lies did not simply harm Dominion, the company lawsuit says. They harmed democracy. They harmed the idea of credible elections. They harmed a once unshakable faith in democratic and peaceful transfer of power. The suit accuses Fox of making false statements with malice and attempting to pass them off as a fact. As for who they believe is responsible, the suit lists a number of public figures, including Dobson Powell, who was a frequent guest on the network. They also mention prominent names such as Tucker Carlson, Sean Hannity, along with show producers and editors. Both parties met on Tuesday and Wednesday to give their arguments in front of a judge, hoping to get a ruling to avoid both parties from having to go to a jury trial, which would begin next month. Fox News is defending their coverage by claiming that the network was merely covering the statements made by the then president and his legal team, which in this case were newsworthy. Now, speaking of other lawsuits the network is facing, it is important to note that Dominion is not the only election technology that has said it has been targeted by Fox News. Smartmatic filed a $2.7 billion lawsuit against the network back in 2022. Moreover, this past week, the network was hit with another explosive pair of lawsuits filed by Fox producer Abby Grossberg, who claimed she was coerced into providing false information in the Dominion case. Grossberg accused Fox's legal team of having engaged in wrongful conduct as they prepared her for her pre-trial deposition in the election technology company case. The lawsuit alleged that given the concentrated efforts and actions from Fox's legal team, it ultimately caused Ms. Grossberg to testify the facts in a false light in order to shift away culpability from senior Fox executives and Fox Corporation. Grossberg claimed that Fox lawyers coerced, intimidated, and misinformed her while preparing her for the deposition testimony. This is relevant given that Fox Corporation, the parent company of Fox News, has asked to get dropped from the lawsuit in the Dominion lawsuit, arguing that it does not play a big role in the coverage decisions at the network. Yet these new lawsuits seem to have complicated Fox Corporation efforts to separate themselves from this mess. Now, this is all the time I have for today, and I will continue updating in the upcoming weeks about how this lawsuit plays out. But right now, back to the desk.
Gustavo, thanks so much. Coming up on Market Shares, Sean Dempsey is in studio for your weekly stock update. Stay tuned.
Your daughter just had her first breakup. Do you A, put yourself in her shoes? B, console her?
Don't worry, sweetie. This is gonna happen a lot.
Or C, find her a new boyfriend?
Nice, single boys. That was weird.
As a parent, there are no perfect answers. But you don't have to be perfect to be a perfect parent. Thousands of teens in foster care will love you just the same.
Welcome back to Market Shares. We're joined now by market analyst Sean Dempsey. Sean, I know you'll have a market outlook on the Silicon Valley Bank collapse in a little bit, but let's start with your picks for the week.
Good morning, Bradley. Unlike in previous weeks, tech giants aren't leading the headlines this time around. Instead, banks and large financial companies are flooding front pages because the United States is on the verge of a potential financial crisis. UBS and Bank of America are two in particular that are seeing a hit in their stock price. But first, before we get into those, I need to talk about everyone's favorite movie and streaming platform, Netflix. No, I'm not talking about John B. and Sarah Cameron, but that may have helped its stock price jump 10% this past week. On Thursday alone, the stock jumped 9% after it was reported that the company's gross additions in Canada have improved. A big problem for Netflix in the past was password sharing and a lack of the revenue streams. Netflix adding ads and an ad-free service was thought as a terrible idea that would kill their business model. However, Netflix says the new service level with ads isn't affecting its ad-free premium service. Now, let's take a quick look at Netflix's one-year chart. Right here is when the stock plummeted because they decided that they were going to stop the password sharing service. But since then, the stock has rallied almost 100% because people saw that it was such a fantastic buying opportunity. Now, not to dampen the mood, but there's sort of a banking crisis going on in our country right now, and that is most certainly affecting the prices of stocks. Bank of America wasn't doing great before inflation picked up, and certainly isn't now. Fear of banks collapsing because of poor asset management is obviously a cause for concern, but Bank of America isn't there just yet. The stock is down 20% over the past month, which is on par with a lot of other banks that are on the New York Stock Exchange. So when we take a look at Bank of America's stock, it's down 38% over the past year, and that's mostly because of the stress with international banks and inflation concerns. And lastly, another bank I need to touch on is UBS. The stock ended flat this week, but according to experts, made the deal of the century. UBS acquired Credit Suisse in an emergency deal aimed at slowing down the pandemic, or the panic surrounding the financial markets. The deal is absolutely necessary to help restructure the Swiss economy. The takeover will reinforce the position of UBS as the world's leading wealth manager with $5 trillion of invested assets, and boost its ambition to grow in the Americas and Asia as well. So taking a look at UBS's stock, unlike other banks, is actually doing really, really well because of that acquisition, but since then has taken sort of a tumble because of things going on in the financial markets. Guys, that's all I got. Back to you.
Sean, thanks so much. When we come back, we'll take a look into the market's future with a potential crisis looming.
See you after the break.
They call me Maxie, but I prefer tripod. I was your above-average four-legged homie, and then wham-bam minivan. Some people pity me. Now that's lame. I still run, fetch, and swim. And the ladies love me. I'm the ultimate wingman. Just don't ask me to high-five.
Welcome back to Market Shares. After a wild last couple of weeks, we're now going to take a look at the landscape of the markets from here on out. We have political analyst Luke Radel joining us and market analyst Sean Dempsey. Sean, I'm going to go to you first. Let's go to you. What do you see from here on out with the markets and SVB's collapse?
Yeah, so I see that if banking fears continue, that it's going to affect the overall market, and it doesn't matter the stock in particular sector, just everything's going to go down because the back of the American economy is the financial markets. And the question is kind of how similar is this to 2008 with the banking collapse? And I understand that there was real estate problems there, but you can make the argument that we're in a worse position right now than we were in 2008. And I'm not really sure how the Fed plans on fixing that. And it's going to be a really, really long road ahead when people are moving their money right now into money market accounts and from smaller banks into some of larger banks because they just don't trust the smaller banks. So I guess, Luke, kind of tossing it over to you is like, what's the political angle of this and how can we fix it?
Yeah, I think these mid-sized banks are getting very concerned, and politicians, lawmakers are concerned about this too, which is why many of them are proposing getting rid of that FDIC insurance cap. Right now, it's about $250,000 is insured by the federal government in case of a bank collapse. For the next 2 years, the Mid-Sized Banking Coalition of America is proposing getting rid of it, just saying that all deposits made in mid-sized banks will be insured by the FDIC. On the one hand, it could prevent a possible bank panic. On the other hand, it could also lead to more risky strategy. The Mid-Sized Banking Coalition of America wrote in a letter to regulators saying that doing so will immediately halt the exodus of deposits from smaller banks, stabilize the banking sector, and greatly reduce the chance of more bank failures. So we'll see if politicians have any movement on that in the next couple days.
I think that was something that was really alarming. A lot of people didn't know about all those FDIC limits.
Yeah.
I think the biggest concern is that this could potentially trigger another recession similar to what we saw in 2008.
Yeah, a huge bank run in the banking sector, $42 billion gone in the span of a single day. But that's all the time we have for you this morning on Market Shares. Be sure to follow us on Twitter and Instagram at CitrusTV News, and like us on Facebook and check out our website. I'm Bradley Hoppenstein.
And I'm Peter Elliott. Have a great Sunday, Syracuse.